Good afternoon, everyone, and welcome to the webinar. We're just going to wait another minute or two to give more folks time to sign in, and then we will get started. Good afternoon, everyone, and welcome to the webinar. My name is Dafina Williams. I am OFN's Chief External Affairs Officer, and we are so excited to have you all joining us today for this important conversation about the Community Reinvestment Act. Just a couple of really quick housekeeping notes. We have a pretty large crowd today, so to keep things manageable, please use the Q&A function down at the bottom of your screen to ask any questions. We will try to answer some of them at the end of the presentation. We will likely not be able to get to all the questions just due to the size of the crowd, but we will make our best effort to answer as many of them as we can. We are also recording the session, and we will make this available on our public YouTube page, as well as posting a recap with a link to the presentation on our blog in a couple of days. So with that, let's jump in so that we can maximize our time together today. Back in October, federal bank regulators released the final rule updating the Community Reinvestment Act regulations. This is a landmark moment with big implications for the community development finance industry. The release of this rule is really a culmination of a years-long process to modernize this critical civil rights legislation. Over the past 5 years, OFN has worked closely with our members and partners to weigh in on several reform proposals to update and modernize CRA. We've advocated for changes that would direct more resources to underinvested communities. So we engaged in countless conversations, discussions, working groups, and meetings with so many of you to get your feedback to help us shape our recommendations for how to modernize this critical civil rights legislation that hasn't really been updated since the 1990s. So I want to pause and just thank you for your ideas and your engagement in that work with us. We're now at that moment where the FDIC, the OCC, and the Federal Reserve have released the final rule governing CRA. So this new rule will really reshape the way capital flows to low and moderate income people and places for decades to come. And the updated regulations reflect changes that we've seen to the financial systems over the past few decades. This update, of course, will have implications for the CDFI industry as well, which is why we are so excited to bring you this conversation today. For CDFI loan funds in particular, CRA-motivated banks are a critical source of debt capital, as well as grants, investments, and other type of partnerships that have generated hundreds of billions of dollars in community development lending and investing in things like affordable housing, small business development, and much more. But there's so much more to unpack in the now infamous 1,500 pages of regulation, which is why I'm very excited to kick off this fireside chat today with Federal Reserve Vice Chair for Supervision, Michael Barr, and OFN's President and CEO, Harold Pettigrew, who are going to walk through some of the most important provisions that'll impact our industry and our work. So with that, I want to invite you both to join us on camera, and I'll kick things over to Harold to kick us off.
Wonderful. Thank you, Dafina, for getting us convened today and getting things kicked off. Governor Barr, it's wonderful to be here with you. Thank you for taking the time.
Really, my pleasure.
And I understand you've been very busy considering this release and its importance. So definitely glad you're able to take the time with us today.
Well, it's my pleasure. You know, I'm a long time a fan of the work that you all do and of CDFIs all over the country. So I was very pleased to be able to come here and talk about CRA with you today.
Truly a delight to have you. And let's maybe kick off and just level set a bit. And just to kind of start and open up, why now? We know that this is important legislation, but just for you to level set for us a bit to talk a bit about certainly why now?
Well, the Community Reinvestment Act was enacted in 1977, and the rules that we're operating under for CRA were last updated in 1995, so quite a long time ago. And we thought it was important, all the agencies thought it was important to update those rules to make sure that CRA is operating effectively, that it's meeting the statutory goals of encouraging lending, investment, and services in low and moderate income communities around the country, and that the rule keep up with changes in the banking sector, things like online and mobile banking that weren't really around nearly 30 years ago.
That certainly makes sense from a modernization standpoint. And just to jump in as well to some of the questions we wanted to hit on in this notable, certainly the joint effort in this regulatory framework. Over the past several years, we saw a number of reform proposals start and stop. And at one point, there was a break in the vision for a reformed CRA between some of the regulatory agencies. Why was it important to realign and have the FDIC, the OCC, and Fed working together on this particular rulemaking?
Well, I think it's absolutely critical that we're working closely together on this. This is an area that Chair Jay Powell was also very instrumental in making sure that the three agencies were working together. Vice Chair Lael Brainerd was running this effort before she left the Federal Reserve, and I sort of helped bring it over the finish line. We all thought it was really critical that the three agencies are aligned so that we can provide the clarity and consistency and transparency that both banks and communities really want out of the Community Reinvestment Act. And so I think that jointness, that working together, is really critical for that reason. And I would also say having the three agencies work on it made it a better rule. Having different perspectives and different approaches all coming together with this final product, I think made it a better rule, as did the amazing comments that we got from OFN and from CDFIs around the country, and from banks and from civil rights organizations and community groups. All those kinds of comments helped all the agencies come together in a very powerful way.
And if you could as well level set that for us a bit, too, Governor. What's the time period at which this work had taken place, and how many comments roughly?
Well, the thinking about revising the CRA rules has been going on for a very, very, very long time. This latest round of kind of revisions really started about 5 years ago. And this current version of the approach started about 3 years ago. So it has been a lot of work by the staff of the three agencies over a long period of time. And I think that the work reflects that. The final rule reflects really thoughtful, careful approach. I think it's really a win-win for banks and for communities and for CDFIs and others all over the country.
And with noting certainly the impact and the timing at which we face the last set of changes to the regulatory framework, it's going to take some time, we know, for banks to be able to prepare. And so question on how will the Fed and other regulators work with banks to make sure that they're ready to implement the rule by 2026?
Well, first of all, let me say the three agencies are going to stay joined at the hip on this. So for implementation, we're going to be working really closely together. And we really view this as a partnership with the regulatory agencies, with banks, and with communities to make sure implementation is right. We're going to be working on technological tools to make it easier for banks and to comply, and for communities to understand the work that banks are doing. That could include dashboards and other metrics that make it easier for everybody to understand how the CRA is working. We're of course going to also be doing training of bank examiners. We're going to establish clear examiner guidelines for how to engage. And we're going to be reaching out, like through this webinar, to make sure that communities across the country understand the approach and the new rule, and that banks understand the approach and the new rule. I really do think it's going to take a partnership to make sure that the CRA rules are effective and are serving communities they were designed to serve.
Absolutely. No, that's wonderful to hear that the partnership doesn't stop rather at the rulemaking itself. We know that's just the first phase of much of this. You have many partners on this call, who certainly are committed to being of assistance as well.
And, I would say that, just as comments really strengthen the rulemaking process, getting engagement from banks and communities is really going to be essential to getting implementation right. So we're going to be doing a lot of outreach, a lot of listening, and we really appreciate the feedback and engagement that we get in that process.
That's wonderful. That's wonderful. Now, knowing that the group that we have assembled here today, there's a couple hundred CDFI practitioners and leaders that have joined the call today, and certainly qualified activities. I want to talk with you about, certainly with CDFIs. Maybe let's level set first. You started out certainly appreciation of CDFIs in the industry. Just want to give you a little more space to talk through. Why do you think it's important, certainly for CDFIs to be at the table?
Well, in my experience, community development financial institutions around the country have often been at the forefront of serving low and moderate income communities. And so, first of all, having the expertise of CDFIs at the table is absolutely critical. And CDFIs have been partners with banks. Obviously, there are bank CDFIs as well, but CDFIs who have partnered with more traditional banks and helped banks to expand their own lending, investment, and services in low-income communities. So CDFIs have helped lead the way. CDFIs have helped partner. CDFIs have helped innovate in this space. And that kind of expertise and grounding in innovation is really critical. And the other thing, by their very structure, CDFIs are focused on serving low-income communities. Their leadership, their boards are engaged in the community. And so that kind of mission-driven focus, I think, has been really an effective model for CDFIs and a lesson for how to effectively serve these communities for the broader banking community.
I couldn't agree more, but I might be a little biased from that standpoint. So some of the activities with CDFIs have actually been eligible for favorable consideration for quite some time. Yet in practice, there was uncertainty on the part of both banks and CDFIs about whether activities, especially those outside of assessment areas, would count. How does the rule address that concern?
Harold, you're right. CDFIs have always been able to be eligible. Bank activities with CDFIs have been eligible. But there was lack of clarity about how much kind of proof the CDFI had to bring to the table, and therefore the bank had to bring to the table kind of on a project by project or entity by entity level. And so that, I think, somewhat dampened the way in which banks related to CDFIs. So under this new rule, there are a number of important steps that we take to make sure that those bank CDFI relationships are strong. One of those is that the rule makes it clear that activities with certified CDFIs are always considered in a bank application. So there's not a need to kind of re-up each project or entity level. The rule counts eligible community activities that occur anywhere. So activities with a CDFI that occur outside a bank's branch network still count under the final rule. And so that broadens the range of CDFI eligible activities. The rule also creates a specific category of community development that is focused on eligible activities with CDFIs. So CDFIs are specially called out. And also, a bank's activities with CDFIs come into play in the qualitative assessment of whether a bank is being specially responsive to the needs of low and moderate income communities. And that can be used to enhance a bank's community development performance. There's also a way under the retail lending test that CDFIs are taking into account. So retail lending focused partnerships with CDFIs are considered when assessing the responsiveness of a bank's credit products that are offered in a safe and sound manner. So in each of these ways, CDFIs are kind of built into the structure of the rule. And I expect that we'll see more of these kinds of partnerships with bank engagement with CDFIs, building on the excellent bank CDFI partnerships that currently exist.
And that framework is great to hear, and being responsive. Typically CDFIs, and I know when I ran a CDFI, you go to where the needs are, versus sometimes the lines that can be drawn, for different purposes. So that's great that flexibility is there to meet the CDFIs where the impact is needed.
Yeah, I think that kind of flexibility, there are lots of areas in the rule where we provide that kind of flexibility. And I do think it will open up opportunities for banks to serve low-income communities in new ways.
Now, the final rule is clear that banks will receive favorable consideration for activities undertaken with certified CDFIs. Why was it important to highlight CDFI certification? And we kind of hitting on this. We're kind of hitting on this a little. To highlight CDFI certification as a meaningful credential for banks looking to partner with CDFIs.
Well, I think certification this is certification by the Treasury Department, just so everybody listening online is clear. Treasury Department certification makes everything standardized, consistent, transparent. And so bank examiners don't need to wonder, is this CDFI really serving low and moderate income communities? Does it have representation, appropriate representation on its board and things like that? So that kind of clarity and consistency, I think, will help the CDFI field, will help banks, and will make it possible for examiners to do this in a transparent way.
Yeah, that's one significant piece of activity as well taking place. Naturally, the update to the certification framework is one of importance.
Yeah, and let me also be clear. It could be that entities that are not certified CDFIs might still be eligible under another rubric of community development, but they just won't meet the test for being a CDFI under the rule.
Good deal. And you noted the community development test, and just to ask some questions there. A big shift that has drawn praise from the industry, from the community development finance industry, was related to the balance between retail lending and community development. Tell us a little more. Talk us through why it was important to ensure that there was a balance between evaluating a bank's performance in both retail lending and community development obligations.
Carol, this is one of the many areas in the comment process where we got both banks and community groups saying we want an improvement that they both agree on. And so this is an area where the comment process was really quite helpful. And both banks and communities were saying an even split makes more sense because even though the volumes are very large on the retail lending side, or can be, community development is hard work. And we want to acknowledge the hard work of that community development and make sure that there are strong incentives to engage in that work, because it can be incredibly impactful in helping low and moderate income communities through affordable housing, through economic development, through a service provision. So we wanted to make sure that that balance was right, so that the hard work that goes into high impact activities can be rewarded appropriately, can be considered carefully under the community development test.
And another concern from many in the industry was that under the proposed rule, banks would shift their focus away from more complex and time-consuming, exactly this point that you're lifting up now, and time-consuming community development investments versus leaning into community development lending activity. How did the rule ensure that community development investments continue to focus for a bank on their CRA, community development strategy?
Well, Harold, yeah, this is exactly the kind of thing that I was getting at before, because it's the case that community development investment is hard work.
Yeah.
And banks know that, and community organizations know that, CDFIs know that. So the comments that we got on this were super helpful, and we, in the final rule, made a couple of adjustments to make sure that we acknowledge that hard work. So, one of them is that we have a specific community development investment metric in the final rule that measures the volume of a bank's investments relative to its deposits. And that applies to banks over 10 billion in size. And in qualitative terms, we also can take into account the way that a bank is structuring its community development activities, the difficulty of it, the innovation in it, the impact of it. So the qualitative factors are, as important as getting the quantitative factors right. And then lastly, I'd say, we particularly call out low-income housing tax credit investments and new markets tax credit investments to highlight the impact and responsiveness of these equity investments to community needs. So these are some of the ways that, we tried to capture, again, both quantitatively and qualitatively, the importance of community development investments to serving low and moderate income communities.
That's great. Great addition there. To shift gears a little, and I know we're talking about community development, which, depending on the community, that can really dictate what the needs are.
Mm-hmm.
And knowing that there are different challenges and sometimes deeper challenges, particularly in rural and native communities, and also persistent poverty communities. And so I want to shift gears there. Too often we see that our rural and native communities are left behind when it comes to bank investment. Under the previous CRA, many banks simply did not have these communities in their assessment areas. And as a result, there was little CRA motivated lending or investment, frankly, flowing into those communities. The regulators took seriously the charge to address those shortcomings in this rule. How does this new rule facilitate meaningful investments into some of these communities and markets?
Well, Harold, first of all, you're exactly right. I mean, there are many communities in the United States that really don't have access to banks at all, or a very small number of them. And so you can get remote areas, rural areas, persistent poverty areas, and especially native land communities where you really don't have enough bank activity, in part because they fall outside of banks' assessment areas. So one of the things that we did in the rule was to say, well, first of all, a bank's community development activities that occur outside of its assessment area will count under the CRA. So you can engage in community development activities anywhere and get credit for doing so. The agencies are also focused in particular on native land areas. And so the rule provides special focus. First of all, defines a native land area and provides special focus that banks can engage in activities in native land areas, again, even if their branch network is not in the native land area. And that is to recognize that, again, the hard work of serving native land areas. It's much harder to make a mortgage loan or to engage in some community development activities. And we wanted to make sure that those areas were getting the appropriate attention. We also, in the final rule, have qualitative factors that examiners will judge whether a particular activity is especially impactful. And one of those factors that we expect examiners to be able to point to is that the work is being done in a persistent poverty area, a rural area, a native land area that might have greater community development needs and where it might be harder to do the work. Those qualitative factors matter. And then lastly, like going back to the kind of traditional set of issues, branches that are located in certain distressed or underserved non-metro areas, including remote or sparsely populated areas or native land areas, get special consideration. So we want to encourage both the activity that happens outside the branch network, but also continue to encourage branch-based activity. So I think all of those measures should really help make sure that CRA is helping banks and communities in rural areas and native land areas, in addition to the work that it does in metropolitan areas.
That's a great framework there. Sticking in some ways along a similar line here, racial equity.
Mm-hmm.
You know, we know we have still some very pervasive issues of race and racial wealth divide across our different communities. Many commenters, including us at OFN, urge the regulators to include an explicit focus on race in evaluating a bank's CRA performance. The final rule did not include an explicit evaluation of race in the exams. Yet we're confronted still with continued racial wealth and home ownership gaps that are driving inequality in our communities. How will this new rule be responsive to those continued challenges? Are there opportunities for banks to engage and work to address these inequalities, like through special purpose credit programs?
Mm-hmm. You're right. So first of all, let me just say, race has unfortunately played too large a role in the way in which financial services have been provided in this country. And still today, we see significant gaps for minority or underrepresented groups compared to others. And so, when you go back to the origins of CRA was part of a set of laws that Congress passed to try and get at this issue. The Community Reinvestment Act, the Home Mortgage Disclosure Act, the Equal Credit Opportunity Act, all of these, and the Fair Housing Act, all of these were designed to work together to root out the kind of discrimination and gaps that we've seen along racial lines. And so I do think it's quite important that all those tools be deployed and used. In the Community Reinvestment Act rule, we highlight and lift up the opportunity for banks to use special purpose credit programs as one strategy for meeting the needs of their communities. And those programs don't have to have any income limit on them. They don't have to be targeted to a low income community. Special purpose credit programs are seen under the rule as contributing to serving the bank's entire community, which is what they're supposed to do under the Community Reinvestment Act. The rule also calls out and lifts up the role of minority depository institutions. Minority depository institutions have a track record of serving their communities. And the rule acknowledges that special role, highlights the role of minority depository institutions, and shows that banks can get special consideration for being involved with supporting minority depository institutions. The rule also retains the current prohibition on trying to draw your assessment area in a way that would be reflective of unlawful discrimination. And it provides that examiners can downgrade a bank if the bank has engaged in discriminatory or other illegal credit practices. And lastly, let me say it also provides transparency through providing Home Mortgage Disclosure Act data on a assessment area by assessment area basis, so that information, this is for large banks, information on race, ethnicity, and income of bank borrowers and applicants can be understood by a local community on an assessment area by assessment area basis. So that kind of disclosure, I think, is also quite helpful.
Great. Shifting gears as well, and part of this is to make sure we're maximizing your time as well with us. And so I'm touching on a number of areas, and I know we'll have some time at the end for Q&A for the audience as well. But want to make sure we touch on some of these areas. And it's just such an important regulatory framework with so many different component parts to make sure we touch on here today. The next area I wanted to hit on was climate and resilience. Many commenters requested that the new rule take into consideration climate resiliency investments, especially since the impacts of climate change disproportionately impact low-income communities. The new rule adopts recovery activities that promote the recovery of a designated disaster area and disaster preparedness and weather resiliency activities as 2 of the 6 place-based categories. As an FYI, as well, during our conference back in October, I had made a call for CDFIs to all become climate-focused lenders, keeping their anchor investment activity, but having a climate lens, the reduction of greenhouse gases, reduction of carbon in the atmosphere. And so this is an area of focus as well, not only for OFN, but for our industry.
Mm-hmm.
Can you tell us how the agencies weighed all the potential approaches, and what was the intention behind the 6 place-based categories? Could you highlight a few qualifying activities under the final rule?
Yeah, I'll start, with the point you raised about climate and weather and disaster sets of issues. The final rule creates a community development category for disaster preparedness and weather resiliency. And that enables banks to obtain CRA consideration for a range of banking activities that relate to, adapting to or withstanding natural disasters, as well as the weather-related disaster itself. So the preparedness and the resiliency and recovery are all seen as eligible activities. And the idea of this is to, of course, stay focused on low and moderate income communities, but to make sure that they have a channel to have the right resources they need for disaster preparedness, resiliency, and recovery. And so some examples include the construction of flood control systems in a low and moderate income area, or promoting green space in targeted census tracts. A lot of low income census tracts, particularly in urban areas, have excessive levels of heat because of the lived environment, the space that is there. And so creating green space in targeted census tracts can mitigate that. Looking at weatherization upgrades for affordable housing, I think, is another important area, including more efficient heating and air conditioning systems, more energy efficient appliances. Could include things like community solar projects or microgrid, micro battery projects. All these kinds of activities would be helpful, or assistance to a small farm trying to adapt to challenges from drought or flooding, or is often the case, alternating years or months of extreme drought and extreme flooding. So small farms could also benefit from this kind of consideration under CRA. And to promote consistency and transparency, we're also imagining that the agencies will publish not only the lists that are in the rule, where there are these illustrative examples of qualifying activities, but also over time that as banks and communities ask about whether an activity is an eligible activity, we'll be able to publish additional kinds of illustrative examples where the agencies have found that to be the case, and therefore banks and communities can rely on that and be able to move forward with projects.
This is an area of deep personal just importance for me as well. And I lifted up a stat of late that from 1980 to 2022, on average, $8 billion worth of damage that's happened across the country for weather-related or natural disaster sort of events. On average, $8 billion a year. This year alone, it was $24 billion. And that was through the month of October. That's not accounting for what may have happened this month in November. And so this is certainly a critical provision, because we know that low income communities are disproportionately impacted, but this is the area that impacts us all.
Mm-hmm. Yeah, I do think that. Sorry, I do think that the intersection of the kinds of risks related to extreme weather events, changes in the climate, natural disasters. As you said, all of these, they affect all of us, but they tend to have disproportionate effects in low-income communities, and low-income communities are under-resourced relative to other communities with respect to their ability to mitigate and and to prepare, and also to recover from these kinds of events. So I do think that this is an area where we can be helpful in providing greater assistance.
Absolutely. The last area I wanted to hit on, you touched on retail lending before, and wanted to make sure we came back to that topic, and then we'll open up for some questions here. While a lot of participants in this webinar are most focused on community development aspects of the rule, there are some really important changes to the retail lending side of CRA, most notably the creation of a new retail lending based assessment area. And we touched on this a little. Can you tell us what these new assessment areas are and which banks will need to designate them under the new rule?
Yeah, there's two kinds of approaches that we take in the rule. One is about designating assessment areas outside of a branch network. These are the retail lending assessment areas. And then we're also at an aggregate level, just looking at all the retail lending activity of the bank outside of its branch network for certain banks. So small banks aren't covered by either of those things. Intermediate banks will look at outside lending on an aggregate basis, but only if the bank does more than half of its retail lending outside of its branch network. And then for large banks, in addition to looking at an aggregate level, large banks that do less than an 80% level of their retail lending in the branch network would also have retail lending assessment areas looked at. So again, most banks won't be covered by this provision, because it's really looking at banks that are not doing as much traditional lending, or they're doing traditional lending out of their branch network, but they have a very high percentage of outside of assessment area activity. And for those institutions, we'll also be looking at retail lending assessment areas. These are areas where they have engaged in lending activity, either in mortgages or in small business lending, above a certain size threshold. And if they're above that size threshold, then they'll also be evaluated individually on each of those things. So if they're above the threshold number of loans for mortgages, they'll be evaluated on mortgages. If they're above the threshold number on small business loans, they'll be evaluated on small business loans. And again, it's designed really to make sure that as the banking world changes and more activity occurs online, that the branch is effectively wherever you are, sitting at your computer or on your tablet or on your phone. We want to make sure that it stays up to date with those changes in the banking sector.
I know we're coming down to our last 20 minutes or so, and want to begin. I do have one final question, but I want to begin opening up for some of the other questions to make sure we get some of the questions that the participants in the webinar have. And I'll just read a couple of them here. Compliance with the new CRA rule is not until 2026. Will activities with CDFIs still generate CRA credit in 2024 in the way described, or are 2024 activities governed by the old rule?
So until the rule becomes effective in 2 years, we're operating under the existing regulatory system where CRE consideration is given for involvement with CDFIs, but you have to go through the process that exists for the normal, for the current structure. We wanted to make sure we had a 2-year implementation period so we get implementation right, to give banks and communities time to prepare, to make sure the data is in place, to make sure the technology tools are in place, the examiner training and the like. So until the new rules take effect, examiners will be looking at the existing rule book, and banks and communities will as well. Now, it may be that some banks begin to get themselves ready for the new rule by engaging in the activities that the new rule encourages. And that will be up to each individual bank to decide at what point on the journey they're ready to flip the switch and move to the new kind of approach.
Next question here. Under the new rule, small quote unquote banks are measured against the lending criteria. Will they receive credit for working with CDFIs if they partner to provide services? If so, is it only incremental benefit?
Small banks can always opt to do the kinds of services that larger institutions do, even if they're not required under the existing rule to do so. So I expect that small banks that are seeing value in connecting with CDFIs will continue to see value in connecting in CDFIs. And the more that the new approach results in increased activity by CDFIs and with CDFIs, the more small banks, I think, will look at that and say, well, this seems like a really good strategy for serving a community. Why wouldn't I want to do that too? So I expect that it will have some useful effects, even for institutions that choose to be governed by the old approach.
Yeah. The next question here, remote rural communities have a big economic disadvantage for renewable energy development. The distance makes it more expensive for the construction, but this the community size, I'm not quite sure what they're saying there. The essence of what they're getting at is the expense because of the distance travel that typically coincides with deeper investments in renewable energy. And there was the desire here to have you just speak a little more about investments in rural communities.
Well, Harold, I think that can be right. I mean, the transportation costs, the infrastructure costs can be more difficult. It may be harder to get the qualified skilled labor to do work. And so that's one of the reasons why the rule especially calls out remote areas, persistent poverty areas, and native land areas for special consideration under the rule, because we recognize that it may be harder to do that work. And we want to make sure banks get credit for doing that work that is harder to do. And I anticipate that kind of approach will provide an incentive for banks to get involved.
Does a bank get additional special consideration for working with minority control CDFIs? And I think we touched on it a bit, but you could circle back to that.
It's the case that the rule kind of calls up and supports minority depository institutions, including minority CDFI institutions. So banks would have an incentive to reach out to MDIs to partner.
One question here touches on credit unions. Specifically asking about whether large credit unions will also have to comply with the tiering structure and regulatory requirements that's outlined in CRA.
Well, the Community Reinvestment Act, as enacted by Congress, is focused on banks. And so credit unions are not covered under the statute. And so they're also not covered under our final rule. Issues about whether credit unions are serving their communities are really governed by the National Credit Union Administration and not by the Community Reinvestment Act.
That's helpful clarification there. So interesting question here. So we're asking you, Governor, to put on a different hat here. So if you were a CDFI lender, you imagine engaging your banking community with the new rules? What are the best new opportunities for CDFI lenders?
Well, that's a great question. First of all, I've never been a CDFI lender. It is really hard work, and I have great respect and admiration for the work of CDFIs around the country, who, as I said at the outset, are really innovating in this space. So I kind of hesitate to provide advice to you, but I would say that the rule does provide new opportunities for you to partner with banks. Because of the great clarity that is provided under the rule. It also provides the opportunity for CDFIs that are serving areas that banks have not been engaged in because they're outside their assessment area. I think this is a real opportunity to say to a bank, hey, you're trying to serve a native land area you've never been in, let me help you, serve that community. Or you're trying to serve this rural area, you've not been part of this in your assessment area, let me help you do that. That kind of partnership, I think, can go a long way. And as I mentioned at the outset, of course, there are CDFIs that are banks that are going to be complying with this new rule as well. And they have a whole set of strategies around all aspects of both their community development work and their retail lending work that they'll need to assess in light of the new rule.
Helpful thought exercise from that lens of things. One baselining question here. Can maybe going back to some of the definitions, can you define special consideration for CDFI activity? Does that mean banks get more credit and thus are more incentivized?
So it involves both a quantitative judgment and a qualitative judgment. So, for example, we have a special test that's a metric where we're looking at how a bank is doing at making community development investments in relation to its size. And then you can compare across banks and see how well they're doing in that. And then secondly, a qualitative judgment about whether the work that the bank is doing is impactful, is meaningful. And I think both of those, both the metric-based approach and the qualitative approach, will help to ensure that banks get consideration for their CDFI activities. And, at the end, this all rolls up to a judgment about CRA performance. But, so you can't take it all in isolation. But I do think that as part of that overall assessment, CDFIs have an important role to play.
One question here back to the retail lending section. I'm gonna give a little bit of a preamble to the question to contextualize it and get to the question. When it comes to retail lending, the importance of access to affordable, responsible mortgages is a key to closing wealth and inequality gaps. CRA has been a driving force in helping mortgage credit reach LMI communities and markets, but the mortgage industry has changed over the last number of decades. We know that so much of our mortgage lending has shifted from banks to non-bank lenders. Non-banks accounted for about 51% of mortgage loans in 2022 compared to about 39% from banks. Yet those entities do not have CRA obligations to serve low and moderate income people and places at the federal level. Have regulators given any contemplation to what CRA means in a world where banks are making a smaller percentage of mortgage loans?
Yes. So first of all, let me say, obviously, we look at the whole structure of the market. The Community Reinvestment Act statute only applies to banks, so it doesn't have coverage of the non-bank sector. Non-banks often sell their mortgages to Fannie Mae or Freddie Mac. Those institutions operate under a duty to serve that the Federal Housing Finance Administration regulates, or they sell them, or they are originating loans that will be FHA mortgages. And FHA has, of course, a focus on first-time home buyers and low and moderate income home buyers. So even where the non-bank sector is not governed by CRA, there are other parts of the federal framework that do influence overall the distribution of mortgages somewhat. And then, in terms of non-bank activity, that is taken into account in how we think about bank activity. So when we're looking at mortgage originations in a community under the CRA, we're looking at bank and non-bank originations when assessing how a bank is doing in serving low and moderate income communities. So it does get reintroduced back into the factor as we think about how good is a bank at serving their local community.
We have a question here specific to climate, or some questions that are coming through actually on climate. Community solar projects fall under place-based activities, but can it also fall under other community development activities such as affordable housing, economic development, and climate and community supportive services?
Yes, the rule provides a lot of flexibility for a lot of clarity in terms of what counts, and a lot of flexibility in terms of how things are structured. So I'd have to dig into the details to know precisely what the questioner had in mind, but as a general matter, that kind of flexibility is available under the final rule.
There was also a question, and I'm not sure that we have the fullest of definitions here, but a question about whether community-based resilience hubs also count as eligible.
I couldn't hear community-based.
Community-based resilience hubs.
I'm not familiar with the term hub in this context, but activity that involves either disaster or weather preparedness or resiliency or recovery, those are all covered by the idea of this category of activity that is eligible for CRA consideration. And so if you're engaged in an activity that is fostering those goals, that's the kind of activity that we have in mind under the final rule. Of course, we have this list of illustrative practices that count in the final rule itself. And then if there needs to be clarification about whether a particular activity is eligible or not eligible, as I mentioned, the bank agencies will work together. So if a question comes in, we can say, yeah, that's an eligible activity, or no, it's not, and publish that as well. And so people will get a good sense over time of areas where there might be gray zones or uncertainty. Those we can continue to learn and describe what is an eligible activity over time.
That's actually one area I'd like to give you a little more space to talk about as well. The process from here. Typically when there is a new regulatory framework, at the local level, I was also a regulator, and I understand like the angst that can come, when a new rule drops, but you've spoken to or intimated towards opportunities for deeper clarification or refinement. Can you talk a little bit about what you're foreseeing over the next couple of years when there are either pain points or rubs that need greater clarity within the implementation of the framework?
Well, first of all, as I mentioned, the agencies are going to continue working very closely together. We're going to be joined at the hip on this. We really do view the implementation period as a partnership with banks and communities. And so we welcome input and suggestions. We're doing a lot of outreach. We'll continue to do outreach during this implementation period. It's really important that we get that feedback because we want to make sure the rule works. We're going to move forward with technology tools that will be helpful to banks and communities. We're going to work forward on examiner guidance. We're going to be moving forward on examiner training. We're going to continue this work about illustrative practices. And so through all these measures, we really hope to continue to receive feedback from groups, CDFIs, banks all across the country on that work. And so I think you can expect to continue to have that kind of engagement. And then once the implementation period starts, in 2 years, that community engagement can't go away. It's got to stay there. It's absolutely vital for CRA's effectiveness that communities stay engaged with that work. It's how examiners know whether a bank is serving a community. It's how banks themselves get input into their work. It's how we know if there's a complaint about a process that might lead to a finding with respect to unlawful practices. So making sure communities stay engaged, I think, is really vital for CRA's success.
That's an excellent point. And want to use that as an opportunity. If there's any other areas that we did not touch on that you wanted to make sure either as guidance to this group here, Governor Barr, or if there's any items we just didn't hit on that you'd like to have some final comments on.
Well, thanks very much, Harold. First of all, thank you and your team for organizing this webinar. Really appreciate your engagement on CRA. I want to thank and express my gratitude and admiration to everybody who's online. The work that you're doing in communities around the country, I think, is really quite vital. And as I said at the outset, I'm just in awe of the work that CDFIs do in communities all across the country. And it has been vital for the progress that has happened thus far, and will be vital for continued progress going forward in serving communities. So just want to close with a very much a thank you to you, your team, and to everybody online.
Absolutely. And we appreciate that sentiment and know that we're from OFN to our broader network and the CDFIs that are all represented here. We're all partners and wanting to make sure just with the same sentiment that the regulatory framework is successful because we know who we're working on behalf of. The importance of the first letter, the C, for CDFIs as well as CRA. And so thank you, Governor Barr, for spending time with us today. This is a lot to get through. It's certainly any ways that we could be of assistance moving forward. Don't hesitate. Let us know.
Thanks very much, Harold, and take care.
Absolutely. Thank you.